All right. Good evening, everyone. Good evening. All right. So, very nice to be back again today to bring you guys another next level live today. So, if you are here right now, can all of you just type hi in the chat so I know that you are here with me? All right. So just type, let me know who is here. I see there's quite a few of you here. Just let me know your name and just type hi in the chat. Okay. So for today, our next level live, I'm going to share with you something very interesting. Okay, which is probably one way or another, right? You would have heard it from your friends, you ever heard it from your families before, okay? At least one of these myths lah. Okay, so what we are going to go through today is that, okay? And I'm pretty sure that when I share them today, you go about thinking, wow, you're right, I got heard of this before, or someone somewhere along the line throughout your investing journey, or if you haven't started yet, maybe this might be something that is causing you to double think. But I am here today to break all of that beliefs. Even though if you are investor and you have been doing this for a while, you might come across certain resistance as well. Okay, so I'm here today to share about that. Now, again, if you are here, for those of you who have just joined, welcome. Please type hi in the chat. Okay, so I know that you are here. Now, let me share my screen right now. Okay, let me share. All right. Okay. So if all of you can see my screen, can I get all of you to type a yes in the chat? Okay. So we're gonna get started right away to the first myth. Okay. So what is the first myth? And don't worry, at the end of today, at the end of the live today, we are going to have some live Q&A as well. So if you guys have any questions about how the market is moving and what is my next move for the market, just feel free to let me know in the chat down below. And in the meantime, while I'm going through all this myth, if it resonates with just let me know in the chat as well. Okay. Now let's get started with the first one. Okay, what is the first myth? Okay, the first myth is this. Okay, the stock market is too risky. It's safer to keep your money in cash. Okay, so if you heard of this myth before, just type me in the chat. Okay, I want to see who have heard of this myth before. Okay, so when I started investing, right, this was what actually my parents told me. Right, they said that, oh, the stock market is very risky, right? It's safer to keep your money in cash. You know, invest lah. And I understand where they're coming from, because during the earlier days, right, my mom and dad actually they actually invested into the Singapore stock market because of tips from others. I remember that my mom, right, every year, right, she will receive this annual report, right, from this yacht company in Singapore, and she don't even know what is that. She just bought it because one of my aunt actually just told her to buy, and she just bought it lah, right? So this was where they came from, and it's understandable. Why? Because at that point of time they didn't have enough information to know all of this thing about stock market, and the whole idea of investing, right, it just seems very, very risky. Okay, and the irony is that they like to go and buy Toto and 4D lah. Very funny lah, right? So, but what is the reality of this? So I'm going to walk you through some concepts. Now, in Singapore, right, what we know about putting our money, right, is what our government give us. Our government has been so kind to give us, which is our CPF, right? Okay, it's our CPF account, right, where every year our OA, our ordinary account, will earn how much? It will earn about 2.5% for the first 20 for the first 3.5% for the first 20K, and then subsequently it is 2.5% for the rest, right? So you can see that at max, our first 20K will maximize lah, but after that, right, it will not, it will only earn 2.5% only. Okay, so that is our CPF. Okay, so you can see, right, this is our current CPF guide lah. Okay, so you can see that OA 2.5%, and then you just the floor interest rate. Okay, let me turn on my laser pen. Okay, and then SE and MediSave, right, is 4%, and RA is 4%. But take note, guys, your SA and your RA, right? You cannot use it for housing. Okay, we cannot use it for housing. We can only for SA, we can only use it after we are 55 when the money goes to our turn to our RA and you know you build like actually we cannot really use it. Only 65 then can use. And for MediSave, right, we can only use it for healthcare. So take note that yes, while this money is growing, right, we do not have liquidity. That means we cannot withdraw this money out anytime that we want. Okay, whereas our OA we can use for property, but you can see that it's back at how much? 2.5%. Okay, and you if invest in our Singapore savings bond, our Singapore savings bond, right now the yield of our SSB, if I'm not wrong, is roughly about 2%. Okay, roughly about 2%. So I want you guys to remember this is the benchmark that we have right now. That our OA benchmark of what we have, we are earning 2.5%. So the whole idea is this. Every single year, our price of goods and service will get more and more expensive because of this thing called inflation. Okay, inflation. Right, price of goods and services will always increase. So for example, 10 years ago, one plate of chicken rice, let's type CR. Okay, 10 years ago, it costs $2. Okay, now today, how much is chicken rice? Y'all can type in your nearest coffee shop. How much is the chicken rice right now in your nearest coffee shop? Just type in the chat. Okay, let me know. My coffee shop, right now nearest chicken rice 450. You see the price increase from 10 years ago $2 now today is $4.50. Again, let me know in the chat how much is the chicken rice okay. Wow, Bowen says it's 350. Wow, still cheap So even you say 350 okay but you see what is the whole idea? The whole idea is that goods and services are getting more and more expensive. Why? Because of inflation. It's just how things are getting more expensive every single year, right? Because the farmers producing their goods, they need more tools, and tools are getting more expensive, and so they need to sell a bit more expensive as well. Okay, so the whole idea is this. And when our money is growing at 2.5% every year, and compared to inflation, which is also increasing 2.5% every year, right? In order for us to actually make money, our money to actually to earn money, right? We need our money to go up higher than inflation. Correct or not? Because if I earn 2.5%, but my price of goods, I also earn 2.5%, right? Then if you think about it, actually you're not earning money, Your money is just matching inflation. You're not earning extra. Correct. Okay, so the whole idea is we must make sure that when we earn the interest rate, we must earn more than inflation. Okay, so that is the whole idea. We want to earn more than inflation. But again, let's benchmark OA. Okay, and if you go and look at our local banks, the DBS multiplier, UOB1, OCBC, on average, the interest rate that you get is around 2%. The effective interest rate is roughly around 2 to 2.5%, very similar to CPF. Okay, now let's look at how much goods and services are increasing every single year. Okay, now how the Federal Reserve or how we benchmark to look at how goods are increasing is through this thing called the US Consumer Price Index, or what we call CPI. Okay, so guys, take a look, guys. Right now, you're going to see just look at both numbers. Right now, right, goods and services are increasing at a yearly rate of 2.9 to 3.1%. How much was our CPF interest rate? 2.5%. Okay. And goods and services are increasing by, let's say, 3% on average. Okay. So our CPF 2.5%, our goods and services is actually going up by 3%. That means effectively, every single year, guys, we are losing 0.5% on our money. Our money is getting more and more worthless every single year. If we just put in our DBS bank, if we just leave it and don't invest and just put in CPF. Hey guys, see that? Right, so don't be lured in by saying that, hey, wow, every single month, I see the UOB can give me $400. Wow, sure, I'm $400 richer every month. Guys, you cannot think like that because you must think from your 100K, right? Instead of putting in the bank, right? How much more can you earn if you put it somewhere else? Can you earn a higher? Because the goal is to beat this, this 3.3%, your goal must be this. If you don't beat this, you're not making money in the long run. Right? So then the question is, if you earn 2.5%, but your price of goods or services is increasing at 3%, are you making or are you losing money? Okay, what do you all think? If you earn 2.5%, but the price of goods and services is increasing only at 3%, are we making or losing money? Okay, this one actually I give the answer already, but I want you all to type and let me know in the chat. So just now I saw Kit, hi Kit, hi CP, hi Bowen, okay, hi Wongo RM, $14 per plate chicken rice. I'm pretty sure it's also increased. Okay, but let me know, guys. When are you making or losing money? Just based on this, just type in the chat. Okay, making or losing. Making, just type making, losing, just type losing. Okay, so this is a food for thought. Okay, and this is just price of goods and services. Okay, remember that. Now, I believe that for most of us, we are also working adults. That means we draw a salary. We draw a salary from our company. And take note, guys, when every single year, right, all of us, me and you, we must demand, not demand, okay, we must make sure that we get the increment every year, no? Because our salary must also be inflation, right? Imagine if 5 year your salary don't increase, every year actually you're losing 3% on your salary, even though the value is the same, right? It's like 5 years ago maybe you earn $3,000, $3,000, right? You take $2 can buy one chicken rice, but 5 year later, right? You still pocket $3,000, but now you want plate of chicken rice, you need to pay 350. You can see the price increase, but your salary remain the same. Okay, so salary is also another thing, right? That we have to account for. And I want you guys to take a look at this survey. So this is a survey that was done by Straits Times lah. Okay, this was about 8 months ago, and this is basically projected pay hikes by sector in 2025 lah. Now, caveat I don't know where or who they interview lah. Okay, but you can see on average what they are saying is that salary will increase lah. Okay, this salary increment will increase by 4 to 5% per year on these sectors lah. I don't know how believable is this. So this one I need all of you to let me know. Where at your job, every year, roughly, how much is your salary increment? Is it 4 to 5%? Or is it really 4 to 5%? Or is it more or less? Right? Let me know. Okay? Because if it's 4 to 5%, it's good. Because you are beating inflation. Right? It's good because remember, now's the benchmark for inflation, it is 3%. So if my salary is increasing at 4 to 5%, good. Then I am beating inflation. So that's a good thing. But what about how are your company? Right? I don't know about your company. Let me know roughly. I mean, you don't need to tell me yours specifically, but historically, what is that percentage increase? But something interesting. So I was reading this article. And there was this was done by HR companies, right? And those like consultants and things like that. And basically what they said was this. Even though they give this table, 4%, 5%, so on and so forth, okay? But you look at what they say. Companies are adopting a cautious approach to salary increment budget in 2025. So to me, it is a bit ironic, right? It doesn't, because first, I can tell you that 4 to 5% every year is a bit on the high side. But suddenly they say that the companies are adopting a cautious approach. And then after that, they say targeted salary increase to navigate uncertain times. This one is very general. Okay, this one is like, I don't know, this doesn't mean anything. What you mean by targeted salary increase to navigate uncertain times is a very general thing. It doesn't mean anything. Okay, so this one, I don't know what it means. So when this Mrs. Lee Cheng Hua said it, I think she's just saying it for the camera and nothing specific. It just say just for, basically say for song. Okay, but you can see, right, that even in companies, right, they are also adopting this kind of a salary approach. So then if let's say your company 1 year don't give you salary increment, you're losing out on interest rate. Okay. So then the question is, okay, Bjorn, so if let's say inflation is increasing at 3% every year, how do I make money leh? Right? I don't know where else to make money. Right? You can see that putting in your bank don't work. What? This is where, right, if you invest in the stock market, right, there will be the difference. Now, this is the S&P index. the S&P index, and this is the stock price chart for the past 5 years. Now, you look at the returns. Okay, what is this trailing returns? Monthly total return, right? Okay, basically what this means is that on a 5-year basis, on average, right, SPY, right, every year, right, they will give about 14%. Just think of it that way. Every year give me 14%. 5 year. Okay, that means year one, that means it's not like year one 10%, year two 10%, year three 10%, so on and so forth. It's like across, if you average out the current share price and 5 year ago the share price, right, it's about 14% every year lah, if you hold the long term. Now, you compare this 14%, okay, versus the 2.5% that we saw. Okay. So if you put in the bank, every year you get 2.5%. But if you put the same money in the index, every year, you roughly you get 5 times more. Let me ask you, is this good or bad? Type in the chat. If you get 5 times more on your money than putting in the bank, is it good or bad? Type in the chat. Okay, because to me it's good lah. Correct or not? It's good lah. Because you can get more for your money ma. Alright, and you're investing in the US stock market, the index, which historically, this is just 5 years. If you see the max, you can see the chart is also a very, very nice uptrend like that. Right. So the whole idea, right, is that if you invest, right, even in the US index, which is the top 500 companies, profitable companies in the United States, your money will grow at a faster rate than you putting in the bank. Right? Okay. So, but the whole idea is people are scared. They're scared that, hey, my money, stock market is very risky. Right? That's why I don't put my money. But then you see, guys, I show you the 5-year chart already. Right? Yes, even though you drop here, right? This portion over here. But you see, eventually you go up and you go up even higher. This one, the Trump credit, you see, you even go up even higher already. So the whole idea is you put your money and you let it work for you. Okay, so this is the first myth that people say put the money in the bank, can really, no need to invest in stock market. But actually you're losing out to inflation all the time. Okay? And you don't need to put all your money, correct? Because sometimes you can just put a portion. You see, even if 5 times, let's say you got 100K, right? And this 100K, right? Even you put 20K, you put in the stock market, you earn the same interest rate as 100K in the bank. Okay, so you can see, right? You can do a mix of both. You don't need to like, oh, all into the stock market also, You can do a mix of both. Okay, so that is the first myth. Now, the second myth is this. You need a lot of money to start investing. This one I think last time it was very apparent. Like, oh, especially for Singapore markets, right? Minimum you need 1 lot to start investing. And 1 lot, right, is 1,000 shares. So if you want to buy companies, right, you have to buy in 1,000 shares. Okay, 1,100. I think 1,000 at that point in time. That means if let's say last time DBS $20, wow, I need to spend 100, not 1,000. I need to spend $2,000. Right, last time when I was a student, then student don't have a lot of money, right? So then we have to go and I have to see, hey, what can I invest? I don't have $2,000 to buy DBS, right? So you can see that limits, right? You can see that, oh, even you want to buy a good company, right? You have to go and pay so much out of your pocket, and you don't have that minimum amount. That is one thing. Another thing is the commission fee is very expensive. Okay, it's very expensive. Now, but over the years, over the past 10 years, the good news is that investing has evolved and it has really changed for the better. That it has become a lot more accessible to anyone. Okay, regardless of your age and anything, it has opened up to a lot of people and become very, very easy for anyone to invest, which is this fractional shares. Okay, so you see, what is fractional shares? Usually last time just now we say that, oh, if I want to buy 1 lot, I have to buy 100 shares. But right now, guys, with fractional shares, you can buy like 0.1 shares, Can you see, right? Just 0.1 shares you also can buy. That is how investing has changed over the years. And let's say, right, Amazon right now, Amazon is, if I'm not wrong, is $200. Okay? Even if you don't have, let's say you are starting, you don't want to put $200, right? Even you buy 0.1 shares, you can start investing with just $20. Not just $100, $20, you also can start investing already. So you can see that how accessible it has become now for all of us to invest, right? And also one more thing, right, is that to take note, right, is that you can buy any companies. You can buy any companies as well. So it's not only Amazon, right? Now it has the brokerage, and not only interactive brokers. You have Weeboo lah, you have Moo, you have Tiger Broker, so many options. And now commissions fees are practically like $1 or free. And you have live data. Right. Wow. Last time I tell you, commission fee we pay $20 one in Singapore broker. $20 commission fee. You have to go and calculate that inside your initial as well. And like you want to sell, also you pay another $20. But now all this is great. When it shows basically how easy it is to invest in the stock market. So then you might say, hey, Bjorn, but then if I put in $20, I put in $1,000, it doesn't move the needle much, ma. Correct? Yeah, that's true. Correct. But the whole idea, right, is to get started. So once you get started, it's like a car, right? When you have a car, right, you need to start the car engine first, ma. Correct. You need to make sure that the engine must warm up first, lah. Correct. You must start the engine first, then you can drive the car. So the same concept is lies for investing, right? You must make sure to start first. You don't just wait, and then you don't do anything. Because that's the worst thing that can happen, which is you don't start at all. Right, but if you by doing these fractional assets can allow you to start, that is a good thing. Right, you can straight away get started. And the important thing, right, is like a piggy bank like that. You start small, you just put the money in, toing, correct? And you keep building up the piggy bank. Keep adding more and more over time. Slowly keep buying more and more over time. Because over time, right, even if you buy higher than your initial of 0.1 shares or whatever it is, right, great companies are in the long run, right, it will always go up. Right. So that's why you must also want to go and buy good companies lah. They have very strong track record as well. Okay. Then once after that your piggy bank full, right, then you will have that pot of gold eventually. Right. So the whole idea of investing is to get started, and you also want to be very, very consistent in what you do. Okay, so remember you can start at any amount, and this is specifically mainly for those of you who are maybe looking to explore investing, or looking to or just thinking like, oh, I only got like $5,000, $500, I don't think I can start. No, actually you can start already. It's whether you want to start or not. So the whole idea, remember, is you make sure you get started, right, and then you keep building up. Okay, don't just start then just leave it there and let it rot lah, right? You must keep adding on to it. Then eventually, right, later on you will see, right, how this money that you put in will keep growing. Okay, so this is myth number two. What is myth number two? Again, it is you need a lot of money to start investing, but that's not true. Okay, you can see even with $20 you can start really. Now let's move on to the myth number three. Okay, myth number three, I think that for those of you, even before we start investing, we think like this is the only way for us to invest, which is this: professional fund manager always beat the market. Okay. So maybe some of you have heard of this before, but some of you may not have heard of this before. But the whole idea is you have probably thought of it before that, hey, I don't know how to invest. Like invest is so technical. I think I give my money to a financial advisor to help me to invest. Or probably when you go to a bank or you talk to insurance agent, they will tell you that they're like, wow, guys, got this, yeah, you can invest in this. Yeah, very complicated one. It's all around the world. You have to choose, but then we give you the service where we can help you to invest everything at once to save your time. Right? If you have heard of this from any one of your financial advisor before, any financial advisor tell you this before, right? Just type me in the chat. Okay, type me in the chat if you have come across this before. And we always have the misconception that, oh, because they are the professionals, right? They can do it better than us. Okay, but let me share with you a story. Let me share with you a story. And this story is it's a true story, guys, not a fake one. It's Buffett's $1 million bet with hedge funds. Okay, so this was back in 2007 when Warren Buffett he bet with these hedge funds asset management firm which is a hedge funds called Protege Partner. So he bet that the S&P 500 would outperform these hedge funds, a group of actively managed hedge funds, right, over 10 years. So that was his bet. He go and bet with these Protege Partners. And why did he make this bet? The whole idea of him making this bet, right, is because he shared that S&P is a very good investment option for most people for many years. And for the index, this S&P, right, it enables investors to own a portion of his company instead of like trying to find the next big stock or whatever lah. And on the other hand, right, for protege partners, what they have is they have 5 funds. So what is this fund of funds? Basically, they selected 5 investment experts who have hired 100 other investment experts, each of them managing their own hedge funds. Okay, so these 5, what they call fund of funds, they in turn, right, they have also own like over 200 hedge funds. So you just imagine that these funds, project partners, got a lot of funds within them and a lot of people managing it. Okay. And in addition, right, these 5 funds, the managers, right, what they can do, right, is that every single year, right, they can keep rearranging their portfolio during the whole 10 years. That means if they find that a company is not doing well, they can rearrange it and they can invest in the next big stock. Okay. And if stocks they are not doing well, they can just exit lah. Okay, and all. So they have that flexibility to change. Whereas for S&P, right, Warren Buffett say, I put $1 million, I just bet and I leave it in 10 years. Now, how did they fare? Okay, I'm sure this is the results that you all are curious about, right? In comparison from the S&P 500 with the 5 other funds. Okay, how did they fare? Right, let me show you the results. Let me show you the results. Now, these are the results. You can see Fund A, 21%. Fund B, 42%. Final returns, Fund C, 87%. Very good. Wow, Fund D, jialat. In 10 years, only do 2.8%, guys. In 10 years, not 1 year. Fund E, 27%. And the average of the 5 funds, in 10 years, they did 36%. Whereas the S&P 500 did 125%. Right? Hey guys, this is not some random random people, no. These are like actual what people call them investment experts lah. Like, I think all of us when we hear the terms hedge funds, right? Then we will think like, wow, hedge funds, wow, powers, they must be so professional in what they do. But you see, guys, even if you alone, you just invest in the index, you will have beaten the hedge funds. Right. And these hedge funds, remember, they have the flexibility to go and invest in many things that they want. They can invest in the next Tesla or whatever. Whereas S&P cannot. Like S&P, you just invest, you put your money, and that means no actions one. Whereas all these hedge funds, they can keep changing, rotating, and whatever, but they still perform lower than just the S&P 500. So what does this tell you? This tells you that professional, like those hedge funds, right, professional experts okay, like this myth always beat the market. This is not true. They don't always beat the market, right? Of course, they are a handful, right? They are always a handful one. Doesn't mean that all hedge funds will fail the market. They're always a handful. But you can see from this bet that these 5 at the very least, and some of them managing so many other investment experts, all of them fail to beat the market. Right? Okay, so you can kind of see like that, that's the reason why. And also don't forget, when you put your money to this kind of hedge funds or whatever, they charge you fees, Wow, you get charged a fee. Imagine your returns in 10 years, 2.8%. And you still have to pay them a fee, every year for underperforming the market. Wow, this is bad, man. Okay, we don't want, what for we give our money to them when they are not making us money? Right. So this is the how hedge funds do lah. And also in future, guys, I give you guys a tip. If any of your of any financial advisor come and talk to you or whatever, you all go and ask them first what is the returns and what is the fee. Okay. And chances are, guys, and also one more thing that I want to share, right? Remember, if you choose to put your money inside this kind of financial advisor hands, right? Y'all cannot just sell anytime y'all want, Y'all can only sell like maybe 2, 3 years, 5 years later. And sometimes even they charge a withdrawal fee if you want to sell. It's very troublesome, But if you choose to do it yourself, you have full control of your money. Full control, full liquidity of your money. You can take out anytime you want. Okay, liquidity is also very, very important. That's the whole reason why, right? That I want all of you, for those of you who are investing, maybe you still have some with the banks or whatever, or for those of you who, if someone has been talking to you recently, right? Okay, I want you guys to think about what you are giving up. You lock your money inside, but what are you giving up at the end of the day? Okay, so this is the third myth. Okay, now before I go on to the fourth myth, okay, well, I want to share something. Okay, so if you enjoyed what we share, okay, all this investment thing, okay, I want to share with you that we are actually me, my good friend, and my investing partner Rachel, okay, we are actually running a free Buffett accelerator acceleration framework. It's an options workshop, and we are holding it tomorrow from 8 to 10 p.m. Okay, so it's not just theory. In this actual lesson, right, we are going to walk through with you the exact process of us identifying great businesses, the same approach inspired by Warren Buffett, but adapted for today's market. And we are also going to share with you the same option strategies that I personally have been using until today. One of my favorites one, right, to make money even though the market has been rallying. Okay, so if you want to join, okay, I suggest of you to join, because we are literally going to share some gems that immediately, right, you can apply straight away. Okay, so what I want you to do next, okay, is I want you can see that the screen there's this QR code that pops up, okay. I want you to, this is the QR code you can go and scan. Alternatively, okay, you can click on this link inside the chat right now. Okay, click on this link inside the chat now, right? And you can just clear and register. Now, I want you guys to, it's completely free, but you all need to go and grab your spot very, very quickly. Because usually this kind of thing, from our experience, it fills up very, very fast because a lot of people want. So usually every class we have close to 100 people or more, right? Because these are the kind of things that it will actually teach you a skill, right? Even this 2 hour free class, once you finish 10 p.m., you can log on to the market and you can actually go and practice already. That's the power of it. So, scan the QR code, okay? Scan the QR code or just click the link in the chat. If you're on your PC, it's very easy. And just click register and key in your name, your email, and you should be able to select the date right away. Okay, I'm going to leave the QR code here first, okay? But if anything, just click the link in the chat box. All right. Now, let's move on to the fourth myth. Okay, what is the fourth myth? Okay, the fourth myth is this. And this one confirm also you all got here before, which is this. You should time the market to get the best returns. Okay, pretty sure lah, right? You all say, wow, I cannot. I need to buy at the bottom. Buy low, sell high. I need to really find the bottom to go and buy. I must really time the market to get the best returns. Okay, so this is probably what every one of us try to do. Like, wow, it rise already, I cannot buy. I must wait until it drop at the lowest point, then I buy. Okay, but let me share with you an actual case study. This one will help you to put things in perspective. Very, very practical one. Okay, so this is a actual case study, okay, actual case study, of 4 investors, and each investor, right, at the start of the year, right, they receive $2,000 and receive for 20 years and ending in 2022. Okay, so what they do is they left the money in the stock market as represented by the S&P 500 index lah. So total for 20 years for 2K, right? How much did they get? Okay, they get total of $40,000 lah. Okay, so how did they fare? Let's go and see. But before that, right, let's go and see the 4 investors first. Okay, the 4 investors. First is investor A, which is the one that we all aspire to be, the perfect market timing guy. Wow, absolutely amazing. This guy, in the whole 20 years, he is a magnificent guy. He has a crystal ball. That means every single year, right, from 2002 to 2022, right, he managed to time the exact market bottom and he put his 2000 inside. Perfect one. On the exact day, exact time, right, he found the bottom, he invests. He always time it. Very perfect. Okay, this is investor A. Investor B is the simple investor. Okay, that means, wow, chill lah. Why? What for? Cannot time the market one. It's impossible to time the market. He believed that timing the market is better than timing the market. So investor B simply just on the first trading day of the year, January 2nd, just put the 2K inside. Don't care. Whatever price it is at, high or low, first trading day, I put $2,000 inside. Simple as that. Investor C is what we call the terribly bad luck investor. Okay, this investor, right, is the opposite of investor A. Instead of timing the market bottom every year, he totally opposite one. He timed the market peak, the all-time high of the market every single year, right? He managed to time it and he invests $2,000. This one is very bad luck, very bad luck guy. Okay, so this is the investor C. And investor D, right, is what we call the T-bills investor or the bonds investor. So what does investor D do? Okay, let me hide the QR code first. I think it's blocking a bit. What does investor D do? Never invest in stock. Simply, like, just believe that, wow, stocks are too risky, and just put 2K in bonds or just hold in cash, like hold in the bank. Okay, just put 2K in the bank. So these are the four investors. Now let's see how they perform. I think you guys will be quite shocked at the results. Okay, let's take a look. Investor A, perfect market timing. You guys see, right? Of course, come out at top, right? You time the market, right? You confirm come at top one. This one, I think we all know at the start. If you time perfect timing, for 20 years, you come out at top, 173K. Now, investor B, simple one. Just at the start of the year, just invest 161K. Guys, notice how the difference is not how small the difference is. And investor C, even damn bad, very, very bad. Still 141K. Not say horrible. 141K is commendable. And investor D, totally never invest one. Just put in the bank or hold bonds. This one really pale in comparison. Even less than half of investor C who time the market top, 63K. Right? So then, the whole idea is this. Even though investor A time the market top, right? Now, my question to all of you is this. And let me know what you think. Can you always enter at the market bottom? Is it possible, right, that every single year you can find the exact time precise to the seconds, to the minute, to the exact day, you can find the exact day and time that the market will bottom and invest or not? What do you think? Yes or no? Can you always enter at the market bottom? If yes, type yes. If no, type no. Right? Because if you ask me, it is practically impossible. Unless you have a crystal ball. Then yes, okay, unless you have a crystal ball, you can time it perfect every year. But if you don't have a crystal ball, it's basically impossible to enter at a market bottom. Right? And you can see even investor A time perfectly 174K. But look at investor B. I want you guys to look at the investor B, how he actually performed very closely to investor A. So close, just a small little 12K difference, even though he simply just at the start of the year just put his money inside. And investor C, even time the market top, also didn't fare too far off. Right. So you can see what's the lesson here. And one more thing about investor A, right? About the perfect timing, is that remember that your emotions come into play. Imagine staying up at night, waiting to go and buy at that time, having lesser sleep and just keep looking at the markets. Whereas investor B, wow, no need worry. At the start of the year, put in 2K, spend 5 minutes, put a 2K in the market, go on with his life for the next year. No need to worry about the market. And it's still very closely to investor A, guys. So you guys see the difference. You guys can see that, even though the difference is a 10K, but then I save so much more energy, so much more time, so much more emotions. Now this is the power of it. Right. So this exact study, right, is proof, right, that yes, timing the market gives you the best return. But the question is, can you always do it consistently? The keyword is consistently. And the answer is no, it is impossible. Whereas if you just buy in and you have a long-term thesis, ultimately you will still come out very close. Okay. And another thing about timing the market, you can see that this is the Dow Jones since 1900s. So this is a full data of 125 years, 124 years around there. Very close. Over a century. You can see that irregardless of everything that has happened, the Great Depression and whatever thing that's happened, right? Everything is on an uptrend. Okay? It is all on an uptrend. That stocks tend to go higher even with bad news. That's why when we invest, we must have a very strong mindset. And we must also have that long-term investing horizon. That let's say, even though, guys, let's say even at the great financial COVID-19, even if you buy at the absolute top, before COVID-19 happened, even if you buy at the absolute top, right now your portfolio will have at the very least double. At the very least, at the very least, we have double already. So you guys can see, right, even though you don't time the market, you still come out stronger. The whole idea is being in the market, which is why there's this saying, time in the market is better than timing the market. Because when you time the market, you just feel good in the short term. right? You feel good that, oh, wow, I buy at the low. But after that, that high will fade off. We are all just chasing for that high when we want to time. But when the high fades off, guys, imagine if you fail to time, then you time the top. Wow, I tell you, that one I've experienced before. It's one of the worst feeling, right? But what if you change that perspective and you think of it as, I know that this money that I put inside this company, in the long run, it will be higher than where it is today. Should I put my money in? I have that conviction and just let it grow for me. You can see how that whole perspective change. And you know that in the next 5, 10 years, you'll probably make more money then and save more energy as well. Okay, so this is myth number 4. Now let's move on to the next myth, which is myth number 5, the last myth. And this one, confirm, I think a lot of you probably, if we all see the market rally, mainly more applicable to those that haven't started investing lah. But for those of you who have also invested before, I think that you have seen your friends telling you this before when you start to share with them about investing, which is this: it is too late for me to start investing. This one, I tell you, not even just probably not your friends or family. If you go to our forums, so this is Reddit. Reddit, you can see 6 months ago, should I invest in the stock market? 11 months ago, is it too late for me to start investing? 4 years ago, is it too late to start investing? 5 years ago, is it 2 years to start too late? 10 years ago, is it too late to get into investing? Guys, instead of writing this post, if you just spend the time to just go and invest, you will have made money. Right. So you can, this is a very common question, a very common myth that everyone has, that, oh, the market has rallied already, I don't think it is time to invest. But here's the kicker, guys. When the market drops, you probably, some of you might probably think, yeah, the market dropped, I think it will continue to drop further. I better not invest now. Then the market rally, right? You will ask the same question again. Wow, market rally already, I think it's too late, right? So then at the end of the day, you will never invest, right? And you will never be rich one. Okay. And you can see, but let me show you some actual numbers. That even if you, even if let's say with a small amount, right? As long as you start, in the long term, you still come out on top. Let me show you why. Now, I'm using a case study. Okay, actual numbers. These are just math. Okay, nothing special, just math. Now, assuming that whatever age that you are, okay, I think a fair portion of us, we probably have $10,000 in the bank lah. Okay, and for all of us who are working, or working adults, right? Every month let's say we save $500 per month. Okay, so with just $10,000, every month we save $500, and these $500 we really save and we put in the stock market, and we put inside the S&P. You know, just now we saw the S&P grow how much? S&P, okay, S&P, okay, they grow at 14% per year, right? Roughly lah. Annualize, okay, in 5 years. So if you just consistently start with $10,000, and every month you diligently, okay, I save this money, I put in the index, because we know that the index long run it goes up, right? In just 10 years, just 10 years, okay, you just think of your age now, you plus 10 years, right? You'll still be young. This amount will grow to $150,000, $170,000 in 10 years. Okay? Right. This is math. Nothing special. Okay. It's really just math. I'm not faking the numbers. And I got this from this website called Future Value Calculator. So if you go there and you key in the numbers, 14%, okay, and 6,000 per period means per year. Okay. That means 500 per month, 1 year, 12 months, right? So you 500 times 12 is 6,000. Every month, 500, you just put in. In 10 years, you will make 169,000. From your $10,000 every year, you put in 6,000. Okay? Now, this is 10 years. If you extend for another 10 years, you guys might think, oh, another 10 years, oh, is it this amount will grow to maybe $350,000? Because you'll see, oh, 10 years, 170, 20 years will be 340,000. Some of you might be thinking that. Let me show you, same thing, the only thing that changed right now is the number of years. So instead of 10 years, right, we continue to do it for another 10 years. Now, guys, look at this. Your amount will 4x. Will 4x, If instead of 10 years, you continue doing it for total of 20 years, same with just $10,000 starting, and $500 diligently you put inside the S&P, you buy the S&P, regardless whatever price, like what we saw in Investor B, right? Simple investor. You just at whatever price, $500, I put in every month. In 20 years, guys, okay, comparatively to 10 years, the amount you will get is 4 times. You guys can see the power. So, and this is just by using $10,000 and 500, guys. Imagine if you have already worked your whole life, right? You have a more base capital, right? And you can have a higher starting amount or a higher deposit every month, or you just want to do a lump sum straight away. Like investor B, right? Simple investor, you just lump sum put in at that price and you just wait. Hey, I tell you, your numbers will be higher. So that's why, guys, every one of us, we can be a millionaire one. I can tell you that the goal to achieve to become a millionaire is actually not hard, right? It's not hard. You just need consistency and you need patience. And of course, not buying into some random meme stocks. Don't be greedy. Okay, be consistent. Okay, be patient. A lot of times, right, we all lose money, right? It's because we are greedy one. Because we FOMO, we see someone go in this way and we think, wow, shit, I want to make that additional $1,500 per month or whatever. That's where actually the market will really, I tell you from true experience, the market will really teach you a lesson and they will make you lose money. And then you make you think like, wow, I don't want to invest anymore. Right? I don't want all of you to go through that kind of thing. And you can see even just by doing consistently this kind of thing, hey guys, you all will be close to a millionaire. No? You give yourself, right, even to 20 years, you give yourself another 2 years, I can tell you, you all will be a millionaire already. I didn't put the calculator here, but you all can try future value calculator. You just key in 22 years, 23 years, right? You'll become $1,000,000. So why is this concept? What is this concept, right? Is this concept called compounding? Okay, compounding. Okay, now when we put our money in the bank, okay, what is happening is we are earning what we call simple interest. That means from the 100K, right, every month, every year, right, effectively we just get back 2%. From the 150K, simple interest, fixed one, every single year, fixed. Now, when you put your money in the stock market, initially it will look like it's the same. But in the long run, it will become a curve. It will be way higher. Now, this is just example, but I tell you, the power of compounding is super powerful one. It will become very, very apparent, right? In the 10, 15 years, you can see how your money will grow to become like multi-baggers from your initial interest. Okay. And many people don't see this. Many people forget this. Many people, right, they always try to do it like this. Every month, so this is, I say, months. Okay. Every month, 1, 2, 3, 4, 5, 6. Everyone try to do this. Every month I want to earn this amount, then go to zero. Every month they aim to earn this amount, then drop to zero. Salary or doing trading. So everyone likes trading now. I was zero. They want to like every month do this. But guys, the thing is, it's not consistent. Sometimes you every month cannot do. Some months you will go down one, right? Some months you will go down. Okay. So the whole idea, right, is that I know it's very alluring, like trading that you see nowadays. But guys, I tell you, when you do trading, what most people don't tell you out there, right, is how much of your emotions you will have to fight with. I can tell you guys from true because I myself, I've also done trading before. Right, I've done forex, I've done crypto, I've done stock, I've done many things. And trading and forex, I tell you guys, it requires very, very strong emotions and requires a lot of your time and requires you to stay up, right? Especially if you all got family. I don't know whether you all can stay up or not, right? So these are what I want to leave with you lah. That you all must think about because there are a lot of ways. I can say that there's hundreds of ways to make money in this world, hundreds of ways. But what works for someone, right, might not work for you. You cannot think that this works for him, it must work for me. No, you cannot think like that because what you are missing is all the emotions, all the training, all the money that one has lost to reach that state. Like, it's like someone learn how to take a degree, right? It takes 4 years to get a degree. You cannot expect you to like this person teach you what he learned in his 4 years, right? To master in 1 month. It's impossible. You have to go through the same phase, ma. Correct. Like learning taking a driving license like that. You have to go through the same phase. You also have to go and take time to go and master. And along the way, in terms of investing, you will lose money. right? The question is, are you able to overcome that? Are you able to have any feedback and guidance to help you tide over that and not give up? Because it's very easy to give up. Okay? Now, so that's why the whole idea is to get started first. The whole idea is get started and you let your money grow for you. And I want to leave you with this. The best time to plant a tree is a Chinese proverb. I love this. The best time to plant a tree is 20 years ago. And the second best time is right now. Okay? Not the second best time, even some people might say the second best time is actually yesterday, not today. It's actually yesterday. Right? So the whole idea is you want to plant it. You don't want to just keep waiting for the best weather to go and plant it or whatever. You just see, plant it first. And then along the way, you learn. Okay, along the way, you just get better at what you do. Okay, so there's no such thing as being too late to invest. To me, it's an excuse. It's just you are not confident or certain of it. Okay, it's just that. But once you have the right people, you are like learning from the right people, you have these people surrounding you, not telling you all these myths, but people surrounding you and telling, hey guys, you all can do it one. And then they show you that the proof that, hey, actually, yes, you can possibly do it. It's possible. It's very, very likely possible as well. Okay, so these are the 5 myths. I hope that all of you have learned something here today. Now, if you have enjoyed it, right, just type, if you have enjoyed today's sharing, just type yes, just like enjoy in the chat, so I know that you like, or you guys like this kind of stuff lah. Okay, so let me know. Just type yes in the chat if you enjoy this kind of things, and definitely we'll do more. I'll do more of it in future as well lah. But before that, guys, I want to give you guys something, because all of you have been with me today, hear me chit chat. I know that I have been probably been talking to myself. Wow, guys, I hope all of you engage with me in future lah. Okay, I only saw like a Kid, CP, Bowen, Wong Gao talking to me and Demio Mangosteen. Hi, I've seen you before. Thanks for always joining the live stream. I really appreciate your support. Okay, Wong Gao, thank you so much. Now, for all of you here, okay, I know it's 30 of you, but even for these 30 of you here today, I have a very special gift for all of you. Okay, this is something that we prepared, okay, and something we want to give to all of you for free, so that when you learn about today's myth, hey Desmond, thank you so much. When you learn about today's myth, you will be able to use this to help you kickstart your journey straight away, which is this free ETF course that we want to give you. It's a free ETF course that is created by both me and Rachel. Okay, a free ETF course created by me and Rachel. Okay, to teach you how to invest in ETF in 3 simple steps. Just 3 simple steps. Okay, all you have to do, very simple. You guys have to just click on the link that is sent in the chat. Okay, just click the link that is sent in the chat. And once the link opens up, you just click the code GIVE. Okay, now I'm going to show you guys how to do it. Okay, so let me simply show it. Okay, now, so just go to this link. Okay, let me go right here. Okay, and just enroll in the course for free, like this. Straight away, just click. Okay, then you just have to sign up. Okay, key in your name, your email, and you will get it. And if let's say there's a place, let's say you see that it costs like 2997, okay, don't worry. Just key in the coupon code GIFT, GIFT. Okay, and you'll be able to get this free ETF course for you. Okay, so we are giving this to all of you for free. This is a very like a step-by-step guide, right, for you to really get started already. Because the last thing I want all of you today, right, is to not take away anything lah. Okay, I want all of you guys to be able to learn something, and let me go press back. I want all of you guys to be able to learn, take away something from today, okay, and be able to apply it right away. That's the whole reason why we are giving you this ETF course as well. Okay, so that's all that I wanted to share. But I think we have some time. I know that is 30 of you here. Okay, wait, some of you DM me. Wait. Okay, I will now DM me about the QR code. Okay, I just share the QR code again over here lah. Okay, just in case you don't need it. Again, this is another, again, 2 free gifts, the free masterclass and the free ETF course. Okay, so you can just click on the scan the QR code, or if you guys need the link again, let me paste it right again. Okay, I think you should be able to key over here lah. Okay, so you can key the link here. I will just type in the chat one more time. Okay, but in the meantime, guys, if you all have any questions about the market, I mean, you all can share me other myths or whatever that you have lah. But if you all have any questions you all want to ask me, hey guys, very rare opportunity. Not all the time I come out to live and you all can ask me questions. But today I have some time, about 5 more minutes. But if you have any questions you want to ask me about the market, what I'm looking at, anything that I'm concerned about, and whatever it is, just don't ask me for stock tips, about like, hey bro, can I buy this now? Should I buy this now? I won't give you all that lah. I don't want you guys to ask me this kind of thing lah. Correct. But if you all have anything about pertaining to the market you all want me to answer, feel free to ask me that, and I'll be more than happy to. I'll be more than happy to see how I can help you guys answer some questions. Okay. So I mean today from what we see in the market right now, there's a little bit of small little pullback lah, right? But a pullback is always healthy. Okay, a pullback is always healthy lah, right? If you go and see let me see. Yeah, a pullback is always healthy. Ahead of estimates cannot grow. Yes, nothing. Hold on. Yes, okay, just reading the news. I thought there was some old news. But generally speaking, there's nothing concerning. It's just stocks are falling a bit, mainly because Trump slapped a fee on this H1B visa which is I don't think is any of a concern but that is just what's hovering in the market right now. At least in the crypto market, there are some dips happening right now. So, but again, crypto is very volatile, so please be extra careful about it Okay. In terms of general market sentiments, there's no earnings or whatever. I think we will start to see earnings coming back again sometime in October, November period Okay, but then we will start to see more earnings coming out again But right now the focus is all on macro, right? It's all on the Federal Reserve, and this week we should have a few events coming up soon. Okay, let me share my screen again so you all can see Okay, so this week you all can see that this is Forex Factory which is what I personally used to track. This will be the key event on Wednesday at 12:35 Singapore time. Okay, we are going to see that Powell is going to speak. Right, what's he going to say? Because right now the market has expected 2 rate cuts to happen in October and in December. So if Powell says something that I don't have any like say something like I think that the data is still very raw, we're going to wait for it, or signify that there's no rate cuts, right? Then we might see some volatility Okay, so just to share some of the things that I am looking at Wow, okay, totally no one got any questions. Wow, for I think there's 30 of you, no one got any questions. Well, no problem. If you all have any questions down the road, you all thought of it later on. For those of you who are watching this on replay, right, just type in the comments down below. Just type in the comments down below, and I'll answer them Okay, when we see them tomorrow. So don't worry, I will be here to answer your questions. But that's all for today. I hope that all of you have enjoyed these 5 myths, and you guys have this have helped you to learn something, right, about seeing things from a whole different perspective. Okay, so that's the end. Thank you all for tuning in, and I'll see you again in the next live stream. Okay, good night, everyone.